Advanced Financial Modeling, Topic 1, Asset Risk and Return, Learning Objective number 6. We're going to estimate asset volatility using the Black-Scholes implied volatility model. So Black-Scholes is, or sometimes called Black-Scholes-Merton model, BSM, is a model to compute the value of a call or put given the spot price of the asset, the option maturity, the strike price, the annualized risk-free rate, and dividend yield. All right, and the model will come up with a price of an option. However, you can use this model in Excel to estimate volatility. Here's what you do. Since the volatility or standard deviation is an input to the model, what you can do is use Excel's goal seek to try to figure out what standard deviation input to the model will give you a Black-Scholes price equal to the actual market price of the option. And it's been shown that this volatility is a reliable predictor of future volatility of the stock. So first thing we're going to do, we're going to grab the Black-Scholes models. There's one for a call, one for a put. And so I am going to go to the file here. I'm going to copy BS call and BS put. Copy. Go to my spreadsheet. I'm going to hit Alt F11. Looks like there already is a module, so I don't have to insert it. And what I'm going to do is I'm going to paste BS call and BS put right below my cap M there. Close that. And now what I can do is I could input that model right here to calculate the price of the option. Notice I've captured a bunch of data here. On March 28th of this year, I saw that Capital One was selling for $147.95. I also went to Yahoo Finance and looked at a 145 strike 1-year option. So my strike is 145. My maturity is 1 year. At the time, Yahoo Finance said Capital One had a 1.62% dividend yield, and at the day I did this, the 1-year treasury was 4.99% since this is a 1-year option. And then what I could do is I could just insert the Black-Scholes model. Again, these are for call options. So I'm going to insert BS call. I'm going to just come up here, click on FX, user defined, BS call, and I'm going to put in my spot price of the asset, tab, strike of the option, tab, volatility. What do I do for volatility? I don't really have an estimate yet. So here's what we're going to do. We're just going to hit cancel. And notice here I have some values in here. Let's delete those. Well, let's just delete the first one. Let's just say we didn't know what the volatility was. So I'm just going to type in my full sample, 31.52. So I'll just type that in, 31.52%. Okay, back to pricing the option. FX, user defined, BS call, spot price of the asset is 147. Strike price 145, maturity 1 year, volatility 31, interest rate 4.9, T is 1 year, and if I slide this down, this bar, you have to make sure you slide this down, and you got dividend yield of 1.62, and there we go. When I do that, whoops, I meant to put that function here. Let's just move that over here. I'm sorry about that. I'm just going to move that here and come here and make that a $sign. That's a useful thing to do in Excel. If you can always just move a cell. And so this tells me that using these assumptions, which all of them are known except for volatility, right? You know exactly the maturity, the strike price, the spot price, the treasury rate. Dividend yield's a bit of a guess. But it tells me that option should be selling at 21.82. On Yahoo Finance, that option was selling for the average of the bid and ask prices was $21.85. Pretty close. But here's what we can do. Let us do a goal seek. What volatility, this 31.52, our guess, what volatility will give us the market price of $21.85? So data, what if, goal seek. I want to set the Black-Scholes price, B29, to a value of $21.85 by changing the standard deviation that's input in the Black-Scholes model, 31.57, hit OK. So that's going to be, I'm going to hit copy and paste. That's going to be my Black-Scholes implied volatility. And it looks like I've already done this for these assets here, so I'm just going to have a link. I've already done all the goal seeks for the other ones. So you could do that for practice, but those are the Black-Scholes implieds for the other assets. Go back to the PowerPoint. Those are my final estimates of implied volatilities for all of the assets. Notice, let's take a look at, again, Capital One. It's really close to the long-term average. The implied vol is really close to the long-term average. So that means that traders and options are just saying, well, it's going to be the same volatility as in the past. Tesla looks like it had been, the long-term average was 61, EWMA 68. Traders are betting volatility is going to fall. SPY, EWMA 17, long-term average 15. Traders are saying 16. When I say traders, option traders are inputting volatility to make estimates of the value of the option. Based on that estimate, they'll buy or sell the option. If I look at EFA, long-term average of 15, EWMA of 17, traders are using about 15, 16. So there you go. That's what we have. These are Black-Scholes implieds. So there's our full set of volatility estimates. I have the 10-year average standard deviation, simple weighted average standard deviation. I have EWMA, which is more of a short-term, what's it been running lately. And then I have the Black-Scholes implied for 1-year options, which should give me a pretty reliable estimate for 1-year volatility. But again, I need to use some judgment. I'm really going to just rely on Black-Scholes implieds. So I'm basically just rounding these numbers to the closest 0.25%, and that's what I'm going to use as my judgment for volatility. So there we go. Topic 1 is done. We have estimated return, expected return using Farmer French and CAPM. We've estimated the volatilities of these assets. In the next topics, we'll combine the standard deviations and volatilities and put these assets into portfolios in which we maximize that trade-off between risk and return. So this was topic 6, learning objective 6 for topic 1.